Hello everyone, my name is Clément Gignac, Chief Economist for IA Financial Group. So over the next 5-7 minutes, I will try to summarize our latest monthly webinar that we have just recorded to the benefit to our advisor and to our clients. But before sharing my thought for 2020, first, Happy New Year. Second, why not make a little post-mortem for regarding 2019 financial asset performance, because you remember a year ago, what a change compared to a year ago, because I remember in early January last year, people was scary, fed up about the performance of their funds and their returns in 2018. All asset classes has negative return, and a lot of folks out there talk about possibility of recession. In our case, I have shared my optimism. If you remember that, the probability of recession did not exceed 30%, and if I'm right that we have no recession, guess what? Usually the market recover the losses in the following quarters. This is exactly what happened. So what explained this huge shift in terms of performance of asset classes from negative 2018 to almost all positive 2019? It's about central banks. As simple as that. It's liquidity. So it was a U-turn basically from central banks. Remember 2018, it was about rate normalization, whatever Federal Reserve or other. 2019, Federal Reserve stopped to increase interest rate, and by midsummer they start to ease again. So that explains why the bond market has rallied so much. We have close to above 75 basis points reduction of interest rate in the long rates, and Wall Street has performed very well. Even the gold and the oil price has rebounded. So which is very unusual to have these four categories perform well. Gold, bullion, of course, oil, and with bonds and stocks. This is our first in 35 years that bullion, gold, bonds, and stocks perform very well at the same time. So how do we see things in 2020? First, on the big picture economy, I invite you to be back to my latest webinar and Facebook in December, because we share our optimism regarding a rebound in the manufacturing sector in 2020 with the trade truce that we have between China and US. So today, my webinar and in coming minutes is more about the opportunity on the capital market. So what is the opportunity? First, on the bond market, make no mistake, I doubt very much that we have such kind of return that we have enjoyed in 2019. Okay, central banks will not increase interest rate, they will not decrease, but it's probably the coupon that we will have as a return. And our colleague teams on the fixed income, in fact, overweight corporate bonds in order to offer a better yield than just treasuries. But it should be normally positive return on the bonds, but not as much as last year. We think that as a strategist and a portfolio manager of a diversified funds, we think that equities provide a better opportunity. So in fact, on equities, okay, U.S. stock market have performed very well in the last few years. As in fact, in the last decades, they beat the EFI big time. But looking ahead, we think that U.S. stock market will have more competition from other asset classes and other categories like emerging market, like European bonds, and like Canadian stocks. I will develop. First, on emerging market, of course, this trade war between U.S. and China has affected a lot emerging countries, because in U.S. external sector is not very important. The economy is 12% of the economy, but South Korea, many emerging market is very important, is between 50-70% of their GDP. So if you have a slowdown of China due to the trade war, guess what? They in fact have a lot of impact. So they trade at 12.5, 13 times forward earnings compared to 18.5 times forward earnings. And in the next few years, where the economic growth would come from, it will come from emerging countries. They explained already more than 50% of the economic growth, but they represent only 15% of the global market cap. So we think they have an opportunity, and this is an election year. Mr. Trump wants to be reelected. He have no appetite, interest to have a trade war. We think that this trade truce will be there until the next election, and probably the US dollar will start to suffer with the Fed on the sideline. So emerging markets should benefit. Second opportunity, Europe. in the last 3 years, it was all about Brexit, and it was a huge saga. But now we have this majority government in UK, so they have ratified the Brexit. And okay, they have many things to fix. Okay, it's not we're not out of the wood yet, but the valuation is very cheap. And what is interesting, UK Central Bank will probably cut interest rate, and the pressure will start to build on Germany to use the fiscal tool, just like Mr. Trump have used the fiscal tool. And in fact, they have the good, clean balance sheet in Germany. And Madame Lagarde, who will now is the leader of the European Central Banks, but the former IMF leader and former finance ministers know very well that we need to use the fiscal tool in order to remove some pressure on the European Central Bank. What's the implication? The implication could be a steepening yield curve because we have negative rates out there. So probably the long rates will start to increase again, and banking stocks will benefit a lot because banking stocks in Europe has been, just like Japan banks, been affected negatively by these negative rates. Third, Canada. So Canada trade at 15 times forward earnings compared to 18 times in US. And if we are right that about a prolonged economic expansion, no interest rate increase, weakening US dollar, guess what? Commodity price will perform well. And Canada, it's about, as you know, energy. We have gold as well, bullion. So gold stocks as well have a more importance in Canadian stock market than other market. So Canada is well positioned for a prolonged economic cycle and a renewed interest on commodities with a weakening US dollar. So that summarizes what we have explained to our advisor on the webinar. But since each of us are different, okay? We think that your objective on investment is different, risk tolerance is different. I invite you very strongly to sit with your advisor and revise your portfolio to have and consider about the opportunity for 2020. So thank you for listening, and thank you for your confidence, and have a good year.